Hello everyone, welcome to Tesla Daily News. Today is June 8th, Monday, and the following is the latest Tesla news. According to market data, Tesla closed at $408.95, up from the previous close of $391, after trading between a low of $394.72 and a high of $412.94, on heavy volume of just over 50 million shares. Short-term trend remains bullish above 400 support. This strong move reflects renewed enthusiasm around Tesla's role in artificial intelligence, anticipation of the historic SpaceX IPO, and growing optimism that Musk's broader tech ecosystem could drive future earnings. According to Blit from Serbia, investor excitement around Tesla is intensifying as markets prepare for what many see as a new Tesla boom. The article highlights that global equity markets have rebounded strongly and that Tesla, as a key member of the S&P 500, is once again at the center of attention. Tesla's share price has risen roughly the high 20% over the past year and around high single digits over the past month, reinforcing its image among local investors as one of the most attractive long-term growth stories. Blick mentions that the core of the new bull thesis is Tesla's pivot from being seen primarily as an electric car company toward becoming a broader artificial intelligence and robotics leader. The piece emphasizes the growing strategic importance of Tesla's humanoid robot Optimus and AI capabilities, suggesting that robots and AI services could eventually become a more important part of Tesla's business than vehicles. For investors, this means Tesla is being re-rated not just as an automaker, but as a high-growth AI platform company, which can justify richer valuation multiples if execution continues. According to Blick News, another major driver of current optimism is the upcoming SpaceX initial public offering. SpaceX is preparing for what could become the largest IPO in history, with a valuation potentially around the $2 trillion mark. Because both Tesla and SpaceX are led by Elon Musk and are increasingly intertwined technologically, the article argues that the SpaceX listing is likely to lift investor sentiment and appetite for Tesla as well. The narrative is that Musk is building a powerful tech ecosystem across Tesla, SpaceX, Starlink, and AI, which is drawing in global capital and retail attention. From an investor perspective, this linkage between Tesla and SpaceX matters in several ways. First, a successful mega IPO for SpaceX could reinforce confidence in Musk's long-term vision and his ability to attract funding for ambitious projects, indirectly benefiting Tesla's brand and perceived optionality. Second, positive media coverage and social buzz around the IPO can spill over to Tesla's stock, driving short-term demand, especially among retail traders who view the Musk universe as a unified story. Third, if deeper technological collaboration between Tesla and SpaceX continues, such as shared AI infrastructure or manufacturing synergies, markets may increasingly value Tesla as part of a broader, Musk-led AI space infrastructure complex. According to The Motley Fool, prediction markets like Calshare and Polymarket are now actively pricing the chances of a merger between SpaceX and Tesla in the coming years. Contracts on Calshare imply roughly even odds that a merger could occur before early 2027, while Polymarket shows a rising probability that a deal could even be announced by December this year. These platforms treat each potential merger outcome like a tradable contract, where the price reflects the crowd's implied probability. The Motley Fool notes that the logic behind such a merger would be to combine Tesla's terrestrial AI assets, electric vehicles, autonomous driving, robotics, and energy storage with SpaceX's orbital infrastructure such as Starlink satellites and potential space-based data centers. Joint projects like the planned Terafab chip facility in Austin already show that operational synergies exist. In theory, after SpaceX completes its huge IPO, it could use richly valued equity as currency to acquire or merge with Tesla, creating a single entity potentially worth over $3 trillion, spanning Earth and orbit. However, the article also warns that prediction markets are not guarantees. Liquidity can be thin, and there is likely significant bias from Musk-focused retail traders, which may inflate perceived probabilities. Any merger would face intense regulatory scrutiny, concerns over competition, governance questions due to Musk's control, and the need for shareholder approval on both sides. For investors, the key takeaway is that merger speculation is adding fuel to the current Tesla rally, but should be treated as optional upside rather than a base case scenario. According to another analysis in The Motley Fool, a competing idea is gaining attention. Instead of merging with Tesla, SpaceX might use its IPO proceeds and stock currency to acquire Nokia. The piece points out that SpaceX's IPO is expected to raise around $75 billion at a share price of about $135, representing the largest capital raise in history. In its filing, SpaceX has clearly signaled an interest in acquisitions and has already been building a vertically integrated AI stack. The Motley Fool explains that SpaceX has invested heavily in its own terafab chip fabrication initiative, uses NVIDIA GPUs for AI training and inference, and has acquired xAI, the company behind the Grok model, to consolidate AI development internally. It is also exploring a deal to acquire Cursor, a developer tooling company. The author argues that the next logical layer is terrestrial communications, and here Nokia's strength in radio access network hardware and its AI RAN platform could fill a missing piece. For Tesla investors, this matters because it clarifies how Musk's broader AI and connectivity ecosystem might develop. If SpaceX were to buy Nokia, NVIDIA would supply AI chips, SpaceX would own the network from orbit to ground, and Nokia would provide cell tower-level AI-enabled infrastructure. Tesla's vehicles, robots, and energy systems could then operate on top of an end-to-end Musk-NVIDIA SpaceX Nokia stack, with Starlink and terrestrial networks providing ultra-low latency connectivity and edge inference. The implication is that Tesla, while not the direct acquirer, might become one of the prime application layers on this sovereign AI infrastructure. Cars, Optimus robots, and distributed energy assets could tap into this network for data, navigation, and AI decision-making, potentially reinforcing Tesla's competitive moat in autonomy and robotics. For shareholders, this strengthens the view that Tesla is part of a much larger Musk-centered AI telecom space architecture, even if the corporate entities remain separate. According to Finanzen.net in Germany, SpaceX is moving rapidly toward its Nasdaq debut under the ticker SPCX, with the IPO set for June 12 and a targeted valuation of up to $2 trillion. The offering size of more than $70 billion would more than double the previous global record. The article explains that Starlink currently underpins SpaceX's financials, contributing the majority of revenue and standing as the only profitable business segment. The report notes that SpaceX's consolidated financials still show significant losses, mainly due to heavy investment in the xAI, now SpaceXI, segment. A large portion of capital expenditure and operating losses in recent quarters has come from AI infrastructure build-out, including the Colossus data centers. An important contract with Anthropic, reportedly worth about $1.25 billion per month at maximum capacity, could dramatically improve the economics of this AI segment, though the agreement is structured as a flexible leasing arrangement that either side may exit with notice. From a governance angle, Finanzen.net highlights that SpaceX will go public with a dual-class share structure, giving Elon Musk 10 votes per special share versus 1 vote for ordinary shareholders. This leaves Musk in near-complete control over strategic direction despite owning less than half of the economic interest. For Tesla investors, this matters because it means Musk will be able to coordinate long-term strategy across Tesla and SpaceX without significant external interference, but it also amplifies key person and governance risks. The piece further describes that the free float at IPO will be very small relative to total shares, potentially causing sharp volatility in early trading. Index inclusion rules may allow SpaceX to enter the Nasdaq 100 within days, forcing index funds to buy, which could push the stock up in the short term. In addition, a staggered lock-up schedule means insider shares will gradually come to market over several months instead of all at once, smoothing selling pressure but extending the period of potential price swings. For Tesla shareholders, the critical insight is that the market is now valuing Musk's orbital and AI ambitions at roughly the same scale as Tesla itself. The $2 trillion SpaceX valuation, roughly comparable to Tesla's upper historical ranges, suggests investors see a combined Earth and orbit AI infrastructure opportunity of multi-trillion-dollar size. This reinforces the narrative that Tesla's AI, autonomy, and robotics business is not isolated but closely aligned with a rapidly scaling Musk-controlled AI and connectivity platform. According to Tagesschau.de in Germany, a recent episode of the 11 Kilometers podcast examined serious concerns around Tesla's Autopilot and full self-driving systems. While Tesla has been a leader in electric vehicles and driver assistance, the podcast discusses allegations of systemic underreporting or obscuring of safety-related issues under Elon Musk's leadership. It references fatal crashes and high-profile incidents that have raised questions about whether Tesla has prioritized rapid deployment and marketing claims over rigorous safety validation. For investors, this type of scrutiny is significant because it touches on both regulatory risk and brand perception. Autonomy is a central pillar of Tesla's long-term valuation story. The company has repeatedly framed its cars as potential robotaxis and has tied this narrative to its AI leadership. If regulators in key markets such as the United States, Europe, or China conclude that Tesla's systems are being misrepresented or insufficiently tested, they could impose restrictions, fines, or mandatory software changes. In addition, sustained negative media coverage can erode consumer trust, particularly in regions like Europe where regulators and the public tend to be more cautious on safety. On the other hand, Tesla continues to collect vast amounts of driving data from its fleet and improve its software with over-the-air updates. Investors must weigh the long-term upside of a successful autonomy rollout against the real risk of legal liabilities, public backlash, and regulatory delays that could slow monetization. According to Auto Liberty Times in Taiwan, Tesla is aggressively cutting effective prices for its Model 3 and Model Y in Japan thanks to a combination of government subsidies and company incentives. The report explains that a rear-wheel drive Model 3 has a list price of about 5.3 million yen, roughly equivalent to a bit over 100,000 new Taiwan dollars. National subsidies for clean energy vehicles, combined with additional local subsidies in places like Tokyo, can total around 2 to 2.5 million yen for qualifying buyers. Liberty Times notes that when all available subsidies are applied, the effective out-of-pocket price for a Model 3 rear-wheel drive can drop to about 3.14 million yen, roughly in the low 60,000 new Taiwan dollar equivalent. In addition, Tesla Japan is offering zero-interest financing and 3 years of free supercharging for orders placed before the end of July, covering both inventory and custom-built vehicles. This places the Model 3's effective price range close to, or even below, certain popular internal combustion models such as the Honda Civic, and not far above the Toyota Corolla base price. From an investor standpoint, this shows Tesla's strategy of using subsidies, financing, and charging perks to trigger demand in markets where electric vehicle penetration is still very low. Japan's EV market share has been stuck at around the low single digits, with strong loyalty to domestic brands and concerns about charging infrastructure. By lowering the total cost of ownership and sweetening the deal with free charging and zero-interest loans, Tesla aims to break through consumer hesitation and gain share. However, the article also cautions that cultural loyalty to domestic automakers, along with slow development of public charging, still pose challenges. For Tesla, success in Japan would not only add unit volume in a large, wealthy market, it would also demonstrate that the company can overcome entrenched local incumbents in regions where EV adoption has lagged. Investors should watch Japanese registration data over coming quarters to see whether these incentives translate into sustained demand. According to STEMI, and data from the German Federal Motor Transport Authority, Tesla achieved a dramatic surge in new registrations in Germany in May. The article states that Tesla's registrations more than tripled year-over-year to just over 5,100 vehicles, making Elon Musk's company one of the standout winners in Europe's largest auto market. At the same time, many German premium brands, including Audi, BMW, Mercedes, and Porsche, suffered declines in monthly registrations. The report explains that overall passenger car registrations in Germany were roughly flat compared with the prior year, but electrified vehicles including pure EVs, plug-in hybrids, and fuel cell cars grew strongly. New registrations of fully electric vehicles increased around the high 30% range year-on-year to about 60,000 units, helped by a renewed government purchase incentive of up to €6,000 per vehicle. For Tesla, this environment is particularly favorable. The combination of national subsidies and heightened consumer interest in EVs is boosting demand, and Tesla is clearly capturing a disproportionate share of that growth. Meanwhile, German incumbents are facing pressure from both ends, from Tesla on one side and from Chinese manufacturers such as BYD on the other, which also recorded large percentage gains. From an investment perspective, Tesla's performance in Germany is a key indicator because the country is both a major automotive market and home turf for many of Tesla's strongest legacy competitors. Sustained share gains here signal that Tesla's brand, product lineup, and local production at Gigafactory Berlin are resonating with European consumers. Strong European growth also helps diversify revenue away from China, where competition is intense and policy risk is higher. According to News AZ, fresh leaks suggest that Tesla's long-awaited new Roadster supercar could finally be only weeks away from launch. Originally unveiled in late 2017 and first promised for 2020 production, the Roadster has faced multiple delays due to the pandemic, supply chain issues, and evolving engineering requirements. Over the past several years, Tesla executives, including Vice President of Engineering Lars Moravy, have periodically confirmed that the program is still alive, but concrete timelines have repeatedly slipped. News AZ reports that Tesla's official specifications still call for a tri-motor all-wheel drive setup delivering over 1,000 horsepower, a 0 to 60 miles per hour time under 1.9 seconds, a top speed above 250 miles per hour, and an estimated range of roughly 620 miles. The car is said to include 4 seats and incorporate cold gas thrusters derived from SpaceX technology, potentially enabling extreme acceleration and handling characteristics far beyond conventional road cars. Production is expected to take place at Gigafactory, Texas. For investors, the financial impact of the Roadster will likely be modest in terms of volume, given its expected high price and niche positioning. However, strategically, the Roadster serves as a halo product that reinforces Tesla's brand as a technology and performance leader. It can draw attention to the company's engineering capabilities, showcase integration with SpaceX technology, and help maintain Tesla's status at the top of the EV performance hierarchy, even as rivals release their own high-end models. The article also notes that some early customers placed deposits of around $50,000 as far back as 2017 and are still waiting for delivery. Managing these expectations and delivering a product that meets or exceeds the long-touted specifications will be important for maintaining customer trust. If Tesla can finally bring the Roadster to market with its promised capabilities, it may also support the broader perception that the company can execute on ambitious technical claims, which indirectly supports investor confidence. According to Orgo in Hungary, a serious traffic accident in the city of Siefok involved a speeding Tesla crashing into an ice cream shop after colliding with another car. Witnesses reported that the Tesla was traveling at extremely high speed, possibly around 150 kilometers per hour, and ignored a stop sign before striking a vehicle carrying 3 young passengers. The force of the impact was so great that it severely damaged the building and even cracked its wall. Orgo describes how the occupants of the struck car suffered various injuries, including head, chest, elbow, and abdominal trauma, while the Tesla driver and her passengers were taken to hospital but did not sustain life-threatening injuries. The report emphasizes the shocking nature of the crash and the extensive property damage. One detail that drew public attention was the reported reaction of the Tesla driver, who allegedly asked about a bottle of wine immediately after the crash. For investors and Tesla enthusiasts, incidents like this underscore a critical nuance. Not every crash involving a Tesla is an autopilot or software issue. The article does not indicate that any driver assistance system was active. Instead, the apparent causes were excessive speed and failure to obey traffic signs, classic human error. However, public perception often associates any Tesla incident with questions about autopilot, which can amplify reputational risk even when the technology is not at fault. The broader point for shareholders is that Tesla operates in a highly visible space where both genuine software-related accidents and ordinary human-caused crashes attract outsized media attention. While this can unfairly color the company's safety image, it also reinforces the long-term rationale for advanced driver assistance and full self-driving systems that aim to reduce human error. Continued transparency around safety data, clear communication about system limitations, and rapid responses to high-profile incidents will remain important for protecting Tesla's brand and, ultimately, its market valuation. According to the Star in Malaysia, Panasonic Holdings is planning a major expansion of its battery manufacturing footprint, with a strong focus on data center energy storage and existing partnerships that include Tesla. The company announced that it will allocate about 350 billion yen out of a previously disclosed 500 billion yen AI infrastructure investment toward its energy unit over the fiscal 2026 to 2028 period. This division already supplies battery cells to Tesla, particularly for electric vehicles. The Star notes that Panasonic intends to begin mass production of battery cells for data center applications at its Kansas plant in the United States by the financial year 2028, which ends in March 2029. Additionally, Panasonic Energy plans to build a third plant in Mexico, also targeting mass production around the same fiscal timeframe. The CEO of Panasonic Energy described a sales target of 950 billion yen for data center-related energy storage systems by that year as a minimum commitment, with ambitions to exceed 1 trillion yen. For Tesla investors, this expansion has 2 important implications. First, a stronger and more geographically diversified Panasonic production base supports Tesla's supply security for advanced cells, both for vehicles and for stationary storage products like Megapack and Powerwall. Stable and scalable cell supply is essential if Tesla is to keep ramping production volumes and meet demand for both EVs and grid-scale storage. Second, Panasonic's focus on data center batteries aligns with the broader surge in AI infrastructure demand and the build-out of massive compute centers worldwide. This dovetails with Tesla's emerging role in AI and with Musk's broader ecosystem, where energy storage, AI computing, and high-performance connectivity will increasingly intersect. If Tesla can leverage partners like Panasonic to offer integrated energy and storage solutions for data centers, it may open additional revenue streams in the infrastructure and enterprise market beyond consumer vehicles. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for future updates.